Hello there. Today we are going to talk about investing. How do you get a good investment? What is a good investment? And I hope that every one of you ends up in a position where I'm making money now, my business is going great, and I need to find a smart way to invest that money. So, I'm going to give you a very specific, although not exact, example in just a second here of some things to think about and what might make a good investment. But first, I want to get in your head a distinction between two kinds of investments, because there are all kinds of investments out there, right? Stocks, bonds, mutual funds, commodities. You could invest in land, houses, real estate. You can invest in businesses, all different kinds of things, right? But I want to talk about two different types of investment. First, let's think about why we invest. The concept is I put money in today, I get more money back tomorrow, the next day, the next year, whatever it is, right? But there is a huge difference between what is called a capital gains investment and what you could call a cash flow investment, okay? You probably already know I am a huge fan of Robert Kiyosaki and Rich Dad Poor Dad. I think his financial literacy for the average person is just fantastic education. And if you haven't read every single one of his books, go do it right now. But he talks about assets. And with my accounting background and as a CPA, of course, I could go ahead and say, he does not define asset correctly, but his definition is actually better. He says an asset is something that puts money in your pocket. And a liability is something that takes money out of your pocket, okay? So in that sense, an asset is an investment. But here's the distinction between the two kinds. One investment, let's go with a high-tech stock, because that's a great example. I buy for $50 today with the prediction that it will be worth, well, if we're back in the dot-com bubble, $7,000 in a week, right? So I am making a prediction, an estimate, not an estimate, a prediction is the right word. I am saying that it is going to be more valuable in the future than it is right now, and then I'm going to turn around and sell it, and I'm going to take the difference. This is operating on very basic laws of economics, supply and demand, scarcity, knowledge and availability of what people can get their hands on for. Because if you buy it at 50 and then in a week somebody sees it's gone up to 7,000 and they think it's going to go up to 14,000 in another week, then you could probably sell it to them, right? Okay. But then you sold it, you made your profit, and it's gone. You don't have the thing that made you that money anymore. And maybe that's a good thing in this case, tech stock, right? But the point is this. The other kind of investment, which I am much bigger fan of, is an asset. Something that you hold on to. It sits up here in your bank account, on your property, however you want to envision it, and it just trickles down money. Month after month, day after day, year after year, you have an income stream. This is how you become financially independent. You acquire enough assets that you just own, you outright own them, and they pay all your bills. No longer do you have to work. You can do with your time what you want. That's the dream. That's the goal, right? I think that is what everybody should strive for. I think this world would be a much better place if people weren't so freaking scared all the time about paying their bills. Imagine the brilliance, the genius that could come out of so many people. A lot of people would probably get high and play video games, but I think there would be a lot of advancement from people with ambition and ideas and desire and all that good stuff. So, the reason I make a distinction between these two, I think it's super important because that's the long-term goal. A great analogy here is real estate. When people talk about real estate, they usually either talk about flipping houses or rental income. Okay? Flipping a house, I put in $300,000 today. I spice it up with another $100,000, so my total investment is $400,000. And then it is worth, in other words, I can sell it for $1 million, whatever. I made a profit, right? And that's great. And maybe then you can do some great things with that profit. But that transaction is over, if that makes sense. The other option is rental income. If I were to take that $300,000 and sure, spice it up again to $400,000, and then I rented it out for, I don't even know what makes sense. Based on where you live, it could vary drastically. I live in Seattle. Renting is pretty expensive right now, but let's say that's like $30,000 a year in income, okay? That is going to come in day after day, month after month, year after year, of course assuming that you have renters, okay? And this is a big point. There is risk in every investment, and there are also variables and assumptions in every investment. Your job is not to try to eliminate them. It is trying to mitigate and manage them. And anybody who tells you there's a risk-free investment, run for the hills. Okay? So, now that we've got that distinction, once more I'll hit it again. It's either a capital gains where you buy something low and sell it high, or it is a cash flow investment where you buy something and it inherently pays you and you continue to own it. Okay? So, that being said, now I want to get into an example of this that a business partner of mine and we were looking at. We didn't end up doing the deal, and I won't give the exact stuff, but we didn't do the deal for other reasons. But it's such a great example of the opportunities that are out there right now, and in general will continue to be there for the people who are willing to look. Okay? So let's get into that example really quick. Okay, we're going to look at some rough numbers, and this is not exactly the deal that me and my partner were looking at, but this should be a relatively accurate reflection of what reflection is a word of what you'll find out there. Okay, so we were looking at keep this in mind, professional services firm doing taxes, mostly personal taxes. Okay. And the purchase price that was being asked was $300,000. This was based off of its top line revenue. That means the gross total amount that it's bringing in sales per year of about $300,000. And this is relatively industry standard for a professional services firm to go for 1 to 1.1, 2, 3, 4, 5 multiple of its top line revenue. Okay? The bottom line, that is the profit after all expenses, was about $50,000 a year. All right? So, this is how this business is currently operating with its current owners. If they wanted to sell for whatever reason, is it a good investment? Now, there are all kinds of assumptions that have to go into that, of course, but let's break down some numbers, okay? So, you could invest and purchase this company from its existing owners with a personal investment, probably, of $30,000. That's what, we were talking about putting down 10%. That would be $30,000 in this case, and then the remainder would go on a loan. There's your loan balance, $270K. Now, there are some terrible interest rates out there, but there are some that you can find that are pretty good too. And dealing with like the Small Business Administration, there are different ways that you can get extremely low rates right now. So we were looking at about an interest rate of 3.75%. Okay? So what this means is based off of the loan balance, the initial loan balance of $270K, every year we would be paying a little over $10,000. And keep in mind, these numbers are rough because the way that loan balances work is you're always paying off the interest and the principal gets hit a little differently and yada, yada, yada. It's a pretty evil scheme, and that's how banks make money. One of them anyways. But let's just say that the interest expense per year is about $10K. So this is an expense now that the business has that it didn't have before. By the way, that's another great added benefit. Interest expense is a deductible tax deductible business expense. So it's not going to impact your income. You're not going to be taxed on those dollars, okay? So if we made this investment, maybe we're not just going to let the business keep going as usual and not take any money out. Maybe we want to start getting paid today. And even if it's a small amount, let's say the new owner would take out $10,000 a year. Where am I? Okay, let's enter that in. I didn't do that one yet. Let's say we're taking out $10,000 a year, okay? So now you're going to have a new net profit, let's call it. Let's call this the business leftover net profit. And that's going to be what we had to begin with minus the additional interest expense minus what we just took out, okay? Now the net profit's down to about $30,000. So again, this isn't exact numbers because of the way that interest works, but if we're making 30 grand a year, it would take roughly 9 years to pay back that loan balance. Okay? So what that means is, of course, there's going to be time investment. Of course, there is risk in any investment. But if I put $30,000 down today, I can get my money back in 3 years and then an additional $10K for the remaining roughly 6 years that the loan still exists. And thereafter, we're back up to the $50K. So this is just an example of what you can find out there right now. And there are all kinds of brokers trying to get all kinds of deals because the baby boomers are retiring, and there are tons of businesses out there that maybe the son or daughter of the owner does not want to continue. And they want to find at least a way to make a little money from it. Maybe there's some attachment, sentimental, maybe there's a feeling of obligation and responsibility to its existing customers and clients. So for whatever reason, the owner wants it to perpetuate. That is how a deal can be made. Okay, so then the question becomes, do I want to do this deal? And I have a very quick and easy rule for you. Opportunity cost. That's all that really matters. Is there a better investment for your money to go into? If not, and if you're not, you might not want to scrape the bottom of your bank account on any investment. You always need to have a little rainy day fund. You always need to have enough to pay the bills, all that good stuff, right? But, and you don't know what's going to happen a week from now. This is why Warren Buffett was famous for keeping something like $20 billion in cash on hand. And people say you can invest that just even in the stock market and in theory make 7% or whatever instead of the half or 1 or 2% he was getting in savings, right? But he said that the ability to be agile, nimble, to be able to move on a dime at a potential opportunity was worth it, was worth that amount to him. So, you can't predict the future, but is your money going to sit in a bank account? Then this, something like this might be a better investment with your money, okay? So, I think there was one other thing I wanted to hit on before this is over. Oh yeah. So this particular investment, was coming, we figured we'd pay off the loan in about 9 years, right? So you say, people start getting into all kinds of fancy acronyms, ROI, ROI, all this stuff. What is a good return on your investment? How long should it take? And the answer is it's going to vary widely. And the one that a good investment, like I said, is the one that is better than your other opportunities. Okay? So, as another quick and fast rule, in my opinion, if I have money sitting idly and I can put it somewhere else, that I will start making money off of it today, immediately, and it will continue to pay me down the line, in theory, past paying off the initial investment, and then making me more money, that's a good investment, right? You took money that was doing nothing, and you bought an asset, and it's going to keep making you money for years to come, all right? So that is what a good investment is in my eyes. Now, of course, the faster you can make your money back, the better. The higher rate of return you can get, the better. But these are getting into the details, and whenever you're making an investment, you should be doing your due diligence. Have to take into account the risk, have to take into account the other opportunity costs that you're passing up. But and of course, any assumptions you're making, like in this example, the company is going to continue operating as it is right now. But that leads me into one more final point that I wanted to make. This was going to be a potentially good investment for us because of, yes, the return that we went over, or, that we figured we could make money basically on day one. But it was also because there was going to be synergy between some of our other businesses. We work on a bookkeeping business, this was a tax service business, and we could basically sell to each of the clients the new service that we are now offering. Okay? So synergies with your existing business, or you could even just say a business that is in your wheelhouse that you really love and you know a lot about, that's going to really reduce your risk and increase your potential overall profit for the investment. So, those are some thoughts. What do you think about this? What do you think about the distinction I made between an asset, cash flow versus capital gains? I didn't even get into the tax implications, but the passive income route is generally better for tax purposes. So yeah, tell me what you think about all this. What's a great investment that you've seen? What's a terrible investment that you've seen, and what's caused that? And what do you think you should do with your money that might be sitting idly by? Thanks a lot for watching, commenting, subscribing, all that good stuff, and I will see you next time.